people. Myself from the traditional territory of many nations, including the Wendat, the Anishinaabeg, the Haudenosaunee, the Métis, and the Mississaugas of the Credit. And Deputy Governor Gravelle from the traditional unceded territory of the Algonquin and Anishinaabeg people. We pay our respect to Indigenous peoples across the country and to their ancestors for their immeasurable contributions to this country. Before we begin, I would like to sincerely thank our event sponsor, Refinitiv, and our gold corporate sponsor, Horizons Exchange Traded Funds. They stand beside us and have shown leadership in helping us educate our members and guests on this important topic. We are grateful for their generosity and support for today's program. A few housekeeping notes. If you have any questions at any point in time during this session, please add them to the Q&A section. You should see a question box at the right side of the screen. Please write your name, email, and question in there, and then click submit. It is now my pleasure to welcome our guest speaker, Deputy Governor of the Bank of Canada, Toni Gravelle. Toni Gravelle became Deputy Governor of the Bank of Canada in October 2019. In this role, he oversees the bank's financial system activities and shares responsibility for setting monetary policy. Mr. Gravelle first joined the bank as an analyst in 1996 and went on to hold various positions within the Financial Markets Department, becoming Managing Director in 2015. In addition to his extensive research experience at the bank, Mr. Gravelle served as General Director of the Financial Sector Policy Branch at the Canadian Department of Finance from 2013 to 2015, and was an economist at the International Monetary Fund from 2002 to 2005. Mr. Gravelle is a native of Corbeil, Ontario, and holds a PhD economics from Western University. Deputy Governor Gravelle, it is a pleasure to have you with us here today, and we look forward to your insights and comments on our topic.
Good afternoon, and hi, Sue. We met a few times in the past. It's nice to see a familiar face. I always enjoy engaging with CFA charter holders. Every day in my role as Deputy Governor focused on financial markets, I use a lot of market lingo that I will be able to use more easily and more freely within the Q&A session than I can in some other groups. And I must also say that it's really weird wearing a suit in this stay-at-home environment. It's been a long time, and my dress shoes are killing me. It's hard to believe we've been dealing with COVID-19 for such a long time as we have. The past year has had a profound impact on people's lives, both in terms of their health and their economic and financial well-being. Canadians count on the Bank of Canada to make sure that the financial system works smoothly, especially in tough times when they depend on credit more than usual. So a year ago, the bank took unprecedented action to ensure that the financial system could keep functioning normally and that the economy could recover. These goals are intertwined. Markets have to work for the economy to work, not just for bankers and asset managers, but for Canadians of all walks of life. An essential part of markets working well is liquidity, the ability to buy, sell, lend, borrow with relative ease. Think of it as the grease that keeps markets lubricated. When COVID-19 struck last year, it caused enormous uncertainty about the next weeks and months, how they would play out. And whenever the economic outlook becomes extremely uncertain, market participants seek to hold cash. Suddenly, investors large and small were scrambling to sell their financial assets, even those normally considered risk-free, such as Government Canada bonds, so they could meet their margin calls and build up their cash buffers. With this dash for cash so widespread, everyone was looking to sell assets and few were willing to buy. Markets came under extreme stress and seized completely. Households and businesses also became extra cautious. Companies were drawing down their lines of credit at unusually fast pace, and households were building up their savings or deferring loan payments. At the height of the crisis, the bank's top priority was to quickly restore well-functioning markets so that households, businesses, and governments could still access credit, either directly from markets or from banks and credit unions. The bank was well positioned for this challenge. As a central bank, we are tasked to be on the lookout for system-wide stresses, and we have the tools that leverage our balance sheet to fix them. I would like to emphasize, however, that our decisions to act was not something we considered lightly. There is a high bar for using these extraordinary tools. The last time we stepped in to address issues like this was more than a decade ago during the global financial crisis. With that in mind, I'll begin by reviewing how the bank responded to the market-wide stress. Then, I'll talk about our thinking behind our actions and update you on the status of our facilities since markets have returned to working normally. Our actions have grown the bank's balance sheet substantially. So I'll close by discussing some policy implications of this and what my governing council colleagues and I are considering as we explore how the balance sheet could evolve from here. Let me first expand a bit more on what happened when COVID-19 struck. By early last March, when the world realized we were in a global pandemic, uncertainty and fear gripped markets. A dash for cash mentality took hold across financial market participants, and liquidity dried up throughout the financial system. The bank responded swiftly and supplied extraordinary liquidity in line with our role as lender of last resort, which I'll come back to in a moment. We launched a broad suite of programs, including some that we used during the global financial crisis, and others we created from scratch. We started by addressing the severe immediate liquidity issues affecting financial institutions in Canada. We knew that if we helped supply them with funding, they would be able to meet the greater demand for credit that was coming from other parts of the financial system, as well as from households and businesses. So the first action we took was to inject significant amount of liquidity into the financial system by ramping up our repo operations. Ramping up term repos is the bank's go-to tactic for alleviating acute market-wide funding shortages and supporting market functioning more generally. We increased the frequency and size of these operations, peaking at $24 billion per operations, and offered funds for longer terms. We also let financial institutions use a wider range of securities as collateral, which made it easier for us to lend them larger amounts than usual. Throughout these extended term repos, we lent roughly $200 billion to financial institutions in March and April alone. We also launched our contingent term repo facility that broadened the list of financial institutions that we engage with for these operations. This provided liquidity to large asset managers that are active in repo markets. The dash for cash caused liquidity to dry up sharply in several core fixed income markets, including, surprisingly, the market for Government Canada bonds. The impact on the market for Government Canada bonds was particularly worrisome. These debt securities are considered very safe and serve as the benchmark or reference rate for almost every other credit market. If the Government Canada bond market can't function smoothly, it's hard for the rest of the system and the economy to work properly. Starting in mid-March last year, the bank rolled out several new asset purchase facilities to support liquidity and restore smooth functioning in a wide range of markets. Our ability to do this quickly and effectively is a testament to the caliber, dedication, and expertise of our staff, many of whom, like you, hold CFA's designations. The bank's purchases helped rebalance the lopsided trading flows in core debt markets, allowing buyers and sellers to set prices. Also, because securities dealers only have so much room for risk on their balance sheet, our purchases helped free up dealers' capacity to provide liquidity in these markets. To complement our extended repo operations, we started with programs designed to unfreeze markets that are key sources of short-term funding for businesses and governments. For example, to support the capacity of commercial banks to support businesses' credit needs, we launched the facility to buy bankers' acceptances. We also began purchasing commercial paper to provide funding for a wide range of companies and financial institutions. As well, we began making large-scale purchase of Government Canada bonds in the secondary market. We launched the Government Canada Bond Purchase Program at a weekly pace of at least $5 billion across the spectrum of short-term and long-term bond maturities. Later, the focus of the program pivoted from restoring market functioning to providing additional monetary policy stimulus while our policy rate is at its effective lower bound of 0.25%. Also, in April, we announced we would be launching programs to thaw other important bond markets and support their functioning through the purchase in the secondary market. We pledged to buy up to $50 billion of provincial bonds and up to $10 billion of high-quality corporate bonds. Collectively, our actions and those of other major central banks took in their own jurisdictions helped to stabilize global financial conditions. The steps we took in Canada to support core markets reflected our responsibility to act as lender of last resort when the financial system is short of liquidity and is under stress. The role goes back centuries. The original description of a central bank's role as lender of last resort came in 1802 from Henry Thornton, an economist and leader of Britain's abolitionist movement. But it wasn't until the late 1800s that British journalist Walter Bagehot created the best-known dictum that, in a crisis, a central bank should lend freely to sound institutions against good collateral and at penalty rates. Bagehot was referring to central banks lending to individual banks that face a sudden funding squeeze, such as a run on their deposits. But in modern times, where financial markets have become another important source of funding, the lender of last resort role of central banks has evolved. Today's lender of last resort can be thought of as liquidity provider of last resort, ready to resolve market stresses when the financial system cannot find its footing and when debt markets are frozen. At the same time, Bagehot noted that while it was important to reduce financial stress, it was also critical to do so in ways that mitigated moral hazard. This remains true today. Moral hazard emerges whenever market participants and other economic actors feel that they can engage in risky behaviors without bearing the consequences if things go wrong. Moral hazard can be limited by offering extraordinary liquidity only in severe situations and by ensuring that such actions have a predetermined expiry date or are unwound when they are no longer needed. Other crisis tools have served this purpose. Central banks should scale them back. Other crisis tools have served this purpose. Central banks should scale them back to show that they are emergency measures and don't reflect business as usual. Facilities can also be structured in ways that discourage market participants from relying on them in normal times. For example, by offering liquidity at a cost that's above typical market rates. The bank's response to market-wide stress last year included some programs that carried different degrees of punitive pricing and others that did not. Because our top priority was to thaw frozen markets quickly, we felt that punitive pricing could undermine that critical objective in some cases. We also lent at prevailing market-determined rates through an auction process, but sought to constrain the unwarranted use of most of the facilities in other ways. We will be reviewing various extraordinary actions to assess whether they were calibrated ideally and whether we could do anything differently in future episodes of market stress. Major central banks, international authorities and regulators, and policy organizations such as the Financial Stability Board are actively studying these issues too. In addition, we are all looking at whether any further structural reforms could be made to improve the resilience of the financial system and minimize the likelihood that extraordinary tools will be needed in the future. The main point is that when central banks provide liquidity, we have to do so in ways that don't encourage market participants to take undue risk in normal times. Our actions must be targeted at specific issues and scaled back as those are resolved. That is why we gradually adjusted our facilities as conditions improved. In the autumn, we wound down a couple of facilities, including the program to support markets for bankers' acceptances. We also fine-tuned our repo operations, making them less frequent and scaling back the types of collateral that we would accept. And now, I'd like to announce that in the coming weeks, the bank will suspend or discontinue crisis programs, market liquidity-focused crisis programs. Specifically, we will suspend our term repo operations indefinitely beginning mid-May. Similarly, the contingent term repo facility will be deactivated in early April. We can take these steps because there is now ample system-wide liquidity for financial institutions to draw from. This is both in terms of their own unusually high levels of deposits, as Canadians saved more during the pandemic, and the large amount of cash, more specifically settlement balances, that we have added to the financial system. In addition, the commercial paper, as well as the provincial and corporate bond purchase programs, will not be extended beyond their upcoming planned one-year end dates. Corporate and provincial borrowers have unfettered access to fully functional debt markets. And credit spreads for most of these borrowers are either at or below pre-pandemic levels. So it's clear that these extraordinary facilities are no longer required. Rest assured, though, that the bank will be ready to reactivate any of these market programs should severely stressed market conditions ever re-emerge. As I said at the outset, our facilities and purchases of financial assets have grown the bank's balance sheet considerably. It now stands at close to $575 billion, more than 4 times bigger than before the pandemic, when it was roughly $120 billion. Ultimately, our actions to support liquidity and markets provided timely support for the economy too. They ensured that the impact of our very low policy rate could be felt in all corners of the economy and that credit could flow freely to Canadians to set the stage for the recovery. But it's useful to think of the assets added to the bank's balance sheet as falling into roughly 2 separate buckets, serving different objectives. The first bucket contains our holdings generated from the facilities aimed at supporting market functioning. The second bucket holds our Government Canada bond purchases. As I noted a few minutes ago, at the height of the market stress, these Government Canada bond purchases were largely aimed at supporting market functioning. You may recall also I said that as we moved into the summer, the purchases' main impact shifted to bolstering our monetary policy stimulus. Making large-scale purchase of Government Canada bonds is known as Quantitative Easing, or QE. QE works through different channels, and the importance of each depends on what's happening in markets and the economy. During times of market stress, QE purchases mostly help improve liquidity, ensuring that the GOC bond market and other debt markets can function smoothly. But once stresses have dissipated, QE purchases also help to lower borrowing costs for households, businesses, and governments by putting downward pressure on bond yields and lending rates throughout the financial system. Our facilities for market functioning caused the rapid growth of the balance sheet during the worst part of the crisis last year, roughly from March to the end of June. By the end of April 2021, though, Government Canada bond holdings are expected to be the largest piece of the balance sheet by far, at roughly $350 billion, or more than 70% of total assets. This is not unusual, as Government Canada bonds are typically the largest asset on our balance sheet. What's different now is the sheer size of those holdings. Still, measured against the size of our economy, the value of QE assets that we've purchased since last March is broadly similar to many other central banks. We are below the Bank of England, about tied with the US Federal Reserve, and ahead of the European Central Bank and the Swedish Riksbank. By another measure, however, our purchases stand out. Our Government Canada bond purchases since last March represent a little over 35% of the total amount of Government Canada bonds that are outstanding, by far the highest among this group of central banks. Let me now turn to how these could evolve. The increase in the balance sheet from programs directed at market functioning will largely roll off because many of those were focused on short-term market support. This has already happened for our purchases of short-term assets such as bankers' acceptances and commercial paper. For short-term funding facilities such as term repos, the process is well underway. Most significantly, about $120 billion is set to roll off between mid-March and the end of April of this year. As it does, the bank's balance sheet, after being relatively stable since July, will decline to about $475 billion, about $100 billion smaller than its level today. In terms of the longer-term asset holdings, the program to buy corporate bonds currently sits at about $200 million in assets, while the program to buy provincial bonds sits at just over $17 billion. At this point, the bank does not intend to sell any of the assets purchased through either of these purchase programs. Of note, at the end of June, we will release transaction-level details for the asset purchase programs that are expiring and for the facilities and programs that have already been discontinued. This supports our commitment to be fully transparent about our actions once the programs ended. Regarding our ongoing purchases of Government Canada bonds, Governing Council is evaluating how the process of adjusting these could unfold. During the current purchase phase of QE, we continue to add monetary policy stimulus because our GOC bond holdings are growing. In October, we recalibrated the program to focus more directly on longer-term borrowing rates. This reduced the amount of term risk that market participants need to absorb, putting downward pressure on term premiums. This shift in composition allowed us to reduce our weekly purchases to a minimum of $4 billion without reducing the overall stimulus coming from QE. At the time of our January monetary policy report, we indicated that if the economy plays out in line with or stronger than our economic projection, we won't need as much QE stimulus over time. And in our March policy decision statement, we said that as we continue to gain confidence in the strength of the recovery, we will gradually adjust the pace of our QE purchases. We also indicated that first quarter growth is likely to be better than we expected in January, and we will have a new economic projection at our April policy decision. I want to be clear here, moderating the pace of purchases while adding to our holdings would simply mean that we are still adding stimulus through QE, but at a slower pace. It would not mean we are removing stimulus. We would be easing our foot off the accelerator, not hitting the brakes. When we start gradually dialing back the amount of incremental QE stimulus that we are adding, we will eventually get down to a pace of QE purchases that maintains but no longer increases the amount of stimulus being provided. That is a pace where our Government Canada bond holdings are largely stable and we reinvest the proceeds of any maturing Government Canada bonds. At that point, the accumulated amount of Government Canada bond holdings will still represent a significant amount of stimulus in the system. I'd like to stress a few things about our journey to this reinvestment phase of QE. First, the process of getting there will be gradual and in measured steps. Second, the timing of these moderations to the pace of purchases and the amount of time we take to get to the reinvestment phase will be guided by our evolving assessment of the macroeconomic outlook and the strength and durability of the recovery. And third, adjusting the paces of QE purchases won't necessarily mean that we've changed our views about when we will need to start raising our policy interest rate. These decisions are distinct. We have committed to continuing our QE program, by which we mean positive net purchases, until the recovery is well underway. Meanwhile, our decision on the policy rate is linked to the economic outcomes described in our forward guidance, which says that we will leave the policy rate at 0.25% until economic slack is absorbed so that the 2% inflation target is sustainably achieved. In the forecast that we published in January, we projected that this wouldn't happen until into 2023. So we would arrive at the reinvestment phase of QE some amount of time before we start increasing our policy interest rate. Eventually, we will reach a point where the Governing Council is of the view that the outcomes outlined in our forward guidance have been achieved, and that will need to start raising our policy rate in order to sustainably achieve our inflation objective. How long it takes to transition through these different steps will, of course, depend on how the trajectories for economic activity and inflation unfold. As part of this journey, we will be mindful of the possibility that our stimulative monetary policy, while essential to achieving our inflation objective, could increase financial vulnerabilities. Rest assured that throughout the normalization process for monetary policy, we will make every effort to communicate clearly and in a timely manner. It's time for me to conclude. We have come a long way from how things were a year ago when severe market-wide stresses forced the bank to act as lender of last resort to the financial system. Our efforts in the face of COVID-19 have had their intended effect. Financial markets have been working much better for some time. Partly as a result of market functioning smoothly, the economy continues to recover, and the downturn last year, while sharp and severe, was not as bad as it could have been if market stresses had persisted. The bank's discontinuation of several facilities and programs reflect the fact that these were extraordinary central bank actions, and it always was our intention to withdraw them once we became confident that the financial markets could function normally without them. Such actions must be reserved for times of severe market stress. And as such, they are not a substitute for steps that market participants take on their own in normal times to manage their risk. While the assets we acquired in the recent crisis to support market functioning will decline, our QE program that supports our monetary policy actions is continuing to add to the bank's balance sheet. As new information on the strength of the recovery arrives, Governing Council will continue discussions about gradually moderating the pace of our QE-related purchases. I just want to repeat my concluding messages in French for our web audience. Pour conclure, les choses sont bien améliorées depuis un an quand les tensions sur les marchés ont forcé la Banque à jouer le rôle de prêteur de dernier ressort pour le système financier. Nos efforts ont eu l'effet attendu. Les marchés financiers vont beaucoup mieux depuis un bout de temps et ça a contribué à la reprise. Le ralentissement de l'an dernier a été brutal, mais pas aussi grave que si les tensions avaient persisté. La décision de mettre fin à plusieurs programmes montre que ces mesures étaient exceptionnelles. L'intention a toujours été de les arrêter quand on aurait confiance que les marchés n'auraient plus besoin et elles doivent être utilisées seulement quand les intentions sont fortes. Et elles ne remplacent pas les mesures que les participants au marché prennent pour gérer les risques en temps normal. Les actifs achetés pour soutenir les marchés pendant la crise vont abaisser, mais le programme d'assouplissement quantitatif va continuer à ajouter à notre bilan. À mesure que le conseil de direction aura une meilleure idée de la vigueur de la reprise, il poursuivra cette discussion sur l'ajustement graduel de ce programme. Merci pour votre attention. Thank you for attention. Now I'd be happy to take some questions.
Mr. Gravelle, we have lots of questions, but we'll start with this one. Does the Bank of Canada share similar concerns as the investment community about the recent steepening of the yield curve?
So we've been monitoring the recent steepening in the yield curve. Really, it's important to understand why the yield curve is steepening. I mean, we've seen a series of good macroeconomic news, and there's increasing signs that the recovery is improving. And as such, it's very clear that the market participants are taking that into their pricing of bond yields. And as such, it's a normal reflection of economic growth being stronger. We also take into account when we make our policy decisions of global financial conditions, including financial conditions in Canada, and this incorporates not only the yield curve, but incorporates credit spreads, stock market valuations, among other things. And as such, financial conditions always play a role in our decision-making process and our outlook for the economy.
Thank you. Would the Bank of Canada ever consider buying equities during a period of financial market stress like the Bank of Japan has done?
So we have on paper the capacity to buy equities, but it's kind of the break the glass kind of capacity. Our main go-to process for supporting to reducing financial market stress is really focus on credit markets, debt markets. Our intention is to make sure that the markets are unblocked and that credit flows freely across the financial system so that businesses, households, and governments have access to that credit. And that credit allows for a rebound in economic activity as it gets used. So it's kind of way out of the tail, and I don't think it wouldn't be our go-to for any foreseeable kind of crisis.
Okay. Now to the housing sector. The housing sector is a record part of GDP and mortgage growth, and it's unprecedented. When does this become an issue? The bank only recently acknowledged early exuberance, despite house prices rising by over 25% nationwide. What is your view on that?
Well, I mean, our macroeconomic outlook is also affected by housing activity. A stronger housing activity actually is one of the factors that upgraded, as we mentioned in the March statement, upgraded our outlook for Q1. We're seeing much stronger housing activity than we expected. So it's always a factor in our macroeconomic outlook and also a factor in our policy decision making. And as the governor noted, we are starting to see signs of excessive exuberance, but as yet, they don't seem to be as severe or as strong as we've seen in 2016 and 2017. I mean, I think part of our analysis that we do is trying to distill between what are fundamental factors of driving house prices and what are the exuberance. For example, the fundamental factors could be driven by a sharp shift in household preferences for larger, less urban homes as supply is stretched. In the short term, you see house prices go up. Or versus we're trying to understand how much exuberance is driving the prices. I mean, one of the concerns we're having is that there's starting to be fear of missing out, FOMO, and that might be driving some of the expectations. But we'll have more analysis in our May FSR, and we're also putting out in the next couple of weeks a kind of a annotated chart package that in terms of the housing indicators that we're looking at.
So building on that, former Bank of Canada Governor Stephen Poloz recently noted that real estate price appreciation was a reasonable trade-off for fighting recessionary conditions, which you had alluded to as well. Do you share this view? And when would real estate price appreciation concern the Bank of Canada?
As I think I mentioned, but I'll repeat, is that when we look at housing, we take into account of our outlook, but when we decide and when we analyze our decisions related to monetary policy, we have in first course always maintaining or getting to our inflation objective. So to the extent that we have this trade-off all the time, we have a financial stability side of our decision-making process that we, like I said, we'll have some more analysis in May. But as we look at housing, we take it both the kind of the macro impact of housing in terms of the economic outlook and our decision in terms of the policy rate and our objective of meeting the inflation target. And we have a framework in place that allows us to be flexible in terms of that inflation targeting regime. And then it allows us to take into consideration any potential stability issues related to that as we decide on policy rate.
Thank you. What metrics will guide you in your decision to normalize interest rates and the flattening of your QE purchases?
So, as I mentioned in the speech, what we're looking at is the strength of the recovery. As we mentioned at several policy statements, we are we're looking for signs of the recovery being well underway. So we're keying off our decisions related to changing the pace of QE off of the strength and durability of the recovery. For our interest rate policy, we're keying off decisions related to that as related to what we've mentioned in our forward guidance, which is related to the output being excess capacity being absorbed, and our inflation, the inflation being at 2%. I think we lost our moderator.
Can you hear me?
Yes, I can, but I can't see you.
Sorry. Oh, you can't see me?
No,
okay.
I wasn't sure if you're still there. Oh, they're still there. Okay. I'm getting signs that you guys are all on.
Yeah. Okay, good. My apologies. We have received several questions about digital currencies. So here's our first. Many see Bitcoin as a harbinger of potential inflation, given the monetary easing undertaken by central banks in recent years. To what extent does the bank take certain asset prices like Bitcoin, gold, and so on into account when formulating views on expected future inflation? Does the bank see themselves in a race with private cryptocurrencies in research and working to develop a digital dollar and maintain the control of the monetary policy and our payment system? Big question.
Yeah, I'm going to take bits and pieces of that. I think it's quite wide-ranging. So I think in terms of cryptocurrencies, there's certain types of that are better as a means of payments as cash than other types. Transactions using Bitcoin are just too expensive in terms of service charges, and their purchasing power is much too volatile. Stable coins have better prospects of replacing money, but none are near that point of being a replacement. one of the reasons why they have better chances of replacing money is that their purchasing power is much more stable, as the name implies. I think the bank, as you know, has been exploring and doing a lot of research related to a central bank digital currency for several years, although we're not at we haven't currently decided to launch a CBDC. We are building our readiness to issue one nonetheless, and any decision to issue one would be keyed off of two conditions. One, that there's a sudden drop in acceptance of cash in Canada. And second, that there's a cryptocurrency that's increasingly dominant as a means of payments, but there are flaws that might jeopardize the financial system. So we have an ambitious work plan related to developing our CBDC and being ready to issue one if these conditions ever appear. And that's going at a fairly decent pace. I refer you to a speech of my colleague, Tim Lane, for a bit more details on that. I think in terms of taking cryptocurrencies into our outlook, and gold, I think you mentioned, I think we do have taken in consideration commodities, real commodities, not currencies. So at this stage, other than real commodities, we don't take cryptocurrencies into our outlook per se. I think I got some of those 5 or 6 questions.
Long question, and it's very complex, but it's good to know that the bank is working very hard and very fast on this developing area. Here's another question. How does the Bank of Canada think about economic inequality that may arise from market interventions?
Yeah, I mean, the bank, we've been doing a lot more analysis related to inequality, not necessarily related to our day-to-day monetary policy process, but understanding the structural factors underlying, for example, labor markets, for example, underlying just having a better understanding of economic fundamentals at a micro level. It's clear, at least within our own institution, we place a lot of importance on inclusive issues. We recently published a D&I strategy, which has in part targets related to amount of women in senior management roles. And I think we think that the economy is better served by having a diversity of views, a diversity of actors, diversity of workers in the system, and it'll be driving a better and more innovative economy at the end of the day.
Thank you. Could you explain why 2% inflation is considered to be a stable rate from your perspective, and how increases beyond 2% would be viewed in terms of future monetary policy initiatives?
So, I mean, the 2% inflation rate is our policy objective. You can quibble if it's stable. I think there's a lot of analysis between having too low of an inflation rate that causes too much friction, and of course too high of an inflation rate as we live through in the 80s and 70s and 80s. Has a long-term drag on potential economic growth and potential economic growth. In terms of the inflation target is 2%. Just to be clear, as well as too high inflation, I think we have a 1% to 3% control band around that 2% inflation rate. It's very clear that that's a control band. Anything above 3%, we would be anxious about, and we have the tools to control inflation, and we pull them out as we normally do. Just to be clear, I think one of our main concerns during the COVID crisis and the economic contraction is that our tools are somewhat less effective in terms of disinflationary dynamics relative to inflationary dynamics. We have a proven set of tools, raising the policy rate in particular, that we are very comfortable using if we saw persistent levels of inflation above our comfort zone, which is 3%. Well, the inflation band is between 1% and 3%.
So do you think, this is another question on inflation, does the bank feel that the market has gotten ahead of itself then when it comes to inflation expectations and all the conversations that we've just had and what you read all the time in the media?
I mean, there's many measures of inflation expectations. I think the questioner is referring to maybe market-based inflation expectations, which are break-even inflation rates. I mean, in markets, there's a dispersion of views out there. There's a bunch of views out there that think inflation is going to be above 3%. There's a bunch of views that think inflation is going to be between 2 and 3%. And there's a bunch of views that have inflation between 2% and below. That dispersion is captured in market prices. And as that dispersion shifts over time, the mean or the median of that is reflected in market prices. So my understanding, looking at the more recent numbers in terms of break-even inflation, that for long-term inflation break-evens are actually lower than short-term break-even inflation measures, if you look at 2-year break-even inflation measures. So we have an inverted break-even inflation curve, if you will. As we said in our January NPR and as we said in our March press release, we also see a temporary increase due in part to base year effects in inflation in the near term in Q2 and Q3, where inflation will move to the top of our 3% range before being pushed down, given the still an ongoing excess capacity in the financial and the economic capacity in the economy. So our perspective is kind of in line with what we're seeing in markets, actually. Also, I think the levels right now in terms of break-even inflation are not too far out of our 0 to 3% inflation band. So I think taken from all that, it's not too big of a concern at the moment. I think what we would be concerned about is sharp destabilizing moves in yields, some sort of overreaction or some sort of self-perpetuating volatility that would be much more a concern for us.
And we have our final question. As a result of the 2008 financial crisis and COVID-19, the millennial generation has only experienced low interest rates. Do you foresee the central bank ever getting back to pre-2007 interest rates somewhere down the road?
So it's true that roughly since the early 2000s, interest rates have been on a downward trend globally. And that this trend has, honestly, it's been a trend since the late 1990s or early 2000s. Taking a longer-term perspective, we are living in a world where the trend rate of growth and the neutral rate of interest, which is R-star, has an implication for our policy rate. As the R-star, the interest rate that where savings and demand for credit kind of offset each other or roughly equal, in the longer term goes down, implies that policy rates as well as bond yields are going to go down over time. And there's a couple factors driving R-star to go down. One is demographics, the aging of the population. The other is lower productivity that we've seen at the same time as that trend. And so to the extent that those trends in demographics and lower productivity and among other factors that are driving or keeping R-star down, the sort of the neutral rate of interest down at these low levels, it's very likely that we'll be at these levels for an extended period of time. That also means that our policy rate will hover in and around, depending on the economic cycle, around low levels of R-star, which we estimate in our NPR at the moment to be in a range centered around 2.25%, with a 1% range around that.
Thank you very much. Mr. Gravelle, thank you very much again for your excellent presentation to our members and their guests today. We are grateful for the stewardship on behalf of yourself and your team and all that you've experienced in the market-wide stress that you've talked to us about today. You certainly have an awful lot on your plate going forward in terms of managing inflation and expectations, and good to know that there isn't any irrational exuberance yet in housing prices, and that you're also working very hard on the modernization side in terms of digitization. So we thank you very, very much for the presentation. I'm sure everyone on the line enjoyed it. And on behalf of CFA Society Toronto, we look forward to many more updates and hope that you don't experience any more market shocks as we go through the next few months so that things can start to stabilize.
Thanks. It's been a pleasure.
Thank you.
Thanks. It's been great. See ya.